GM, good morning. Welcome to the Milk Road Show, the daily crypto show where we leave narratives faster than a first bad date. I'm your host, Jay Hamilton. It's Monday, June the 9th. Last week, Circle had its IPO with incredible success, up almost 4x since its launch last Thursday. So everyone is talking about stablecoins right now, not just from the investment perspective, also from the regulation perspective, and also from the adoption perspective, because stablecoins are just flying right now. So to talk about stablecoins, where we're at right now, where we're going, and the opportunities and how you should think about investing in stablecoins and the framework around that, we are joined today by Sam Broner, investor at A16Z. We're going to talk about how stablecoins have become bigger than PayPal and Visa combined. We're going to talk about the future and the opportunities to invest. Before we jump in, the Milk Road team is going to be at Permissionless at the end of June. That's June 23rd. We have an event where you guys can come out, have some drinks with us, meet the team. Also, if you want to attend Permissionless, you can get $100 off your ticket. Hit the link in the show notes. Today's episode is brought to you by Ledn. Get cash without selling your Bitcoin. It's also brought to you by Meanwhile. Ditch dollars, insure in Bitcoin. Without further ado, Sam, welcome to the Milk Road Show.
How's it going, Jay? Am I going to get an invite to that event at Permissionless?
Oh, yeah. You in New York?
I'll be in New York. Yeah, I'll be in New York for it.
All right, my
Should be
man.
fun.
Yeah, for sure. Yeah,
All
done.
right, great.
Done. Yeah. Sam's going to be there. Even more reason to come out.
Yeah, I'll stop by. That'll be fun.
Give us a little bit of a brief intro of yourself, and then let's lead into a quick convo about Circle's IPO last week. That's
Sure.
obviously
Yeah,
the
yeah.
news of the day around stablecoins.
So, look, I'm an investor at A16Z. I spent a lot of my time on stablecoins, payments, the boundary between crypto and fintech, but I also focus on real world assets. How are we going to tokenize the legacy generation of assets that are currently living in traditional silos? Before I was at A16Z, I was a researcher and engineer at Microsoft, and I did distributed systems. I focused on non-ordered consensus algorithms, and I got into crypto because I realized, look, these are the types of algorithms I was working with. Those are probably a better way to move money, move assets, create composability between siloed data. Ultimately went to MIT, worked at the Boston Fed on stablecoin research, and now I'm an investor, and I already said what I spend my time on, but I couldn't be more excited about how the year is going so far, with people finally waking up to the opportunity of stablecoins.
Yeah, no kidding. It's like
Yeah.
the most obvious thing that is happening in crypto and one of the most exciting use cases, but it's so not sexy, so it doesn't get talked about a lot, and it's difficult to speculate on, right? It doesn't
Yeah.
have the same speculation investment opportunities that some of the other opportunities in crypto have
Yeah.
right now, but that is coming.
I spent a little while walking around saying, guys, obviously payments was going to happen first with crypto. We've been talking about this for 10 years. How
Right.
ridiculous would it be if we had started with a different thing? It had to happen. It's going to drag a lot of DeFi and other exciting parts of crypto forward. But finally, payments cost less than a cent and happen in less than 1 second. It's a better payment rail. And so fintech's waking up to it.
It is a real like Homer Simpson moment
Yeah, that's
every time
exactly
you
right.
think about it, right?
Yeah, I used to say
Uh,
it was the dumbest use of crypto, but now I just think it's sort of the best and first use of crypto.
yeah, yeah. Okay, so let's Circle IPO last week. Incredibly successful IPO. IPO'd at
Yeah,
$31, sitting around $110 as of this recording.
sure.
Just wow, what a start. What's your takeaway from that? What does that signal to you to see a stablecoin company IPO it's with such success?
Yeah, I mean, look, Circle, they IPO'd at 6. They're at 24-ish. Last time I checked, I haven't looked at the market today, but 3.5x after IPO means that there's a lot of latent demand. People want access to the stablecoin narrative. But mostly when I look at this, I just sort of think about the narrative, and I think about all of these fintechs that woke up to stablecoins over the course of the last three months or so. I wrote a piece in May saying this, April and May were the months that fintechs woke up to stablecoin payments because Visa announced the product, PayPal announced the product, Mastercard announced the product, Stripe announced the product, MoneyGram announced the product, and you're starting to see that it's not just Web3 people anymore. You can now spend and save stablecoins using existing rails. And so, look, the IPO is big news. It's a flashy headline. But the biggest news is that people on Wall Street and people on Main Street are both realizing that stablecoins are probably a better way to spend and save. And that's the most exciting part to me.
Yeah, again, I think that it's so obvious to people in this space, and I mean, this is the truth of all tech, right? When you're in early to tech, it feels very obvious, but for everybody outside the space, it's not so obvious. And where we need people to see it's obvious is in the traditional system, because that's where the adoption needs to happen. Let's just talk a little bit about the adoption right now, because I
Sure.
think people don't recognize how big stablecoins really are already. Let me bring up a couple of slides that were shared by your colleague Darren, who's been on the show before as well. Give us an outline of the size of stablecoins right now when you look at them in the payments world comparison to other payment systems.
Okay, so first of all, Darren, God bless him, our data weatherman put this together, and this is available in other places, but I think Darren did the best job breaking this out. There was $33 trillion of payments on stablecoins in the last 12 months. To put that in perspective, that's almost 3x what Visa did. It's something like 30x what PayPal did. ACH, which is another payment rail used by financial institutions and large enterprises, did more. But just like look at where stablecoins are sitting in the overall lineup here. The one of the things that I think people are missing about stablecoins is that the P2P, so person to person, and B2B use cases and the checkout use case when someone goes to a store and buys something, those are also growing really fast. It's not just financial institutions using stablecoins to do arbitrage or make trades. Those use cases are growing in many cases more than 10% a month. So quick anecdote for you, Jay, like I'm an investor. I talked to a bunch of startups doing remittances and cross-border payments this winter. There's going to be 30 of them. All of them are doing millions of dollars in payment volume a month. And all of them basically were growing 10 to 40% a month. So just this like industry wide growth. Darren begins to capture it with just the raw payment volume. But I want to give you a sense of the trenches. Like I'm talking to founders and they're saying, guys, I just helped 20% more people send money from the US to Colombia in February, and just like I'm hearing that over and over and over again, just unbelievable growth. And so it's happening up and down the stack.
The other thing that is really impressive to see, but also sort of points out the opportunity, is another slide that Darren made, which is that stablecoin supply is at an all-time high, and we know. I think we talk about this a lot on the show. It's continued to grow rapidly, but it's still very small in terms of how much of the total US dollar supply has been tokenized. Can you talk to us about how big we are and about how much bigger we could get here?
Yeah. Well, so I thought 1.1% was kind of a lot. Like if I told you that 1% of dollars are sitting in Venmo balances, you would say that's insane.
That's
I mean,
crazy.
1%. Um, So look, this to me represents a quite a big accomplishment, and more than just the volume, it means that a lot of users now have access to these stablecoins, and there's a bit of a network effect here. As more people have stablecoins, there's more reasons for entrepreneurs to build businesses that use stablecoins, more reasons for merchants to accept stablecoins, and there's going to be better integrations with banks and Venmo and fintechs because there's network effects there. My favorite slide from this actually, I think, is the next one, which shows that stablecoin volumes are beginning to be uncorrelated with crypto trading volumes. This is like the money shot to me. The over time, what has happened is the stablecoin usage goes up when more people want to speculate on assets. But what we've been seeing recently is that stablecoin volumes have been going up because more people want to use stablecoins and the services, DeFi, lending, and so forth, that are adjacent to stablecoins. And that is the beginning sign of product market fit for the first category, the first non-speculative category in crypto. And I think it's going to kick off a lot more adoption going forward.
Yeah, it feels like that is exactly what crypto needs, right? A non-speculative use case. Not that speculation is a bad thing, but it certainly has been the use case that we have and that has dominated so far. So let's get other use cases. I want to, before we jump into your a recent article that you wrote, and you talked about some of the issues and the opportunities for stablecoins to continue to grow. I want to show one more slide that
Yeah.
you posted last week, which just is really mind blowing to me. And this is talking about why payment processors are using stablecoins and the cost for payment processors. So you found that if you compare credit card processing to stablecoin processing, that the payment processor makes more than three times more revenue using stablecoins. Can you just walk us through this? Because this is to me just it's so obvious when you see a slide like this.
Okay, right. So today, when you go buy a coffee shop at a local, buy a coffee at a local coffee shop, you spend $2 on the coffee, and the merchant only gets $1.70. The credit card network and the issuing bank are taking 30, maybe 35 cents of a $2 transaction. It's really a lot, and it affects small businesses everywhere. So here we look at a $100 purchase, and how much money does the issuing bank make? Does the card network make in a $100 purchase? They're getting basically $3 out of that. And the merchant, for me, I'm mostly worried about the consumer and the merchant. Like, we don't need Visa and the issuing banks to be like lining their pockets with these fees. The current state of the art in stablecoin based payments, or like the sort of cheapest pricing, is somewhere between 1% and 1.5%. But we're just 3 or 4 months in. I expect that pricing to continue to drop. So the merchant is getting something that costs almost 50% less. They're getting a 50% discount on the ability to receive money. But the crazy part is, because you're cutting out all these middlemen, the payment processor, so someone like Stripe or Adyen or Shift4, they can actually take 3 or 4x more money because they got rid of the issuing banks and the card networks. So it's really this win-win for the payment processors and for the merchants. The only people who lose are the extractive networks. We're okay with that. And I guess when we started talking to payment processors about this new flow of them using stablecoins, what we realize is the ideal amount of fees might not be zero. It might be a, a small but worthwhile bit of spend to encourage the payment processors to do distribution. Because Stripe needs to get a little bit out of this in order to push stablecoins as a new rail. And so we're happy about this initial flow. Like, the fact that Stripe gets to 3x the revenue while offering merchants a cheaper product, this is a great win for everyone, and we're excited to see it play out. I think it's going to lead to a lot of stablecoin adoption.
Is the natural flow here that Visa and Mastercard and all the payment processors are going to fully use stablecoins eventually?
Oh man, it's interesting. These are big companies who have a great business model right now. They've got a lot of profitability. Like, so these and Mastercard are two of the most profitable by margin companies in the world, and that business is built off of owning a network. Stablecoins disrupt that network. They're much easier to program. They're open and permissionlessly composable. If you want to start a fintech today, you can get started today by building and programming stablecoins. If you want to work with Visa and MasterCard or the card networks, you've got to go to an intermediary. You're going to have to give them a cut. It's way harder. There's way more paperwork involved, like just sort of annoying stuff. If you're an engineer or a product person, you're accustomed to using a great cloud services. You don't want to go through and set up your own server. Like, that's kind of the equivalent. Like, you get this awesome product day one with stablecoins. And so that is to say, I think they're going to try to adopt stablecoins. Certainly, I think they're aware of stablecoins. I think they're going to try to make sure their product is compatible. But there's real risk for them, and I think they're going to be cautiously observing how they can continue to maintain their profit margin. And ultimately, it just might not be possible if stablecoins become a core rail for how people do payments in the world.
Hmm. It's it's always interesting to think about how disruption happens and how the incumbents adopt to that disruption. And in this case, as you said, they're in, but they're so profitable. But then you look at Tether and how profitable they are, and you think, well, okay, they're even more profitable than Visa and Mastercard. So
Yeah, look, I mean, Tether is unbelievable. As they're reported, profits have been eye popping. I mean, it's just unbelievable. But yeah, I think the question is, will the existing payment rails self cannibalize in order to embrace what is going to be the next wave of product? And that's always a hard question. Not all companies can make the leap to the next technology standard.
okay, I want to chat now about this concept of the singleness of money and what needs to happen in order for stablecoins to truly become money, which is a little bit of a confusing term because it's very nuanced.
Yeah.
So I want to dive into that, and then I also want to talk about the stablecoin treasury adoption as treasury bills are being adopted constantly by stablecoins. And then we're going to talk about your investment thesis for stablecoins. But before we do that, we should take a quick break to hear from our sponsors who make this show possible. Selling your Bitcoin should be a last resort when you need cash. That's why there's Ledn, the trusted platform for Bitcoin-backed loans. You can unlock cash in as little as 18 hours with no monthly interest payments and no prepayment penalties. They've issued over $9 billion in loans and never lost a single Satoshi of client funds, even during the chaos of 2022. If you're a long-term hodler, this is the move. Get liquidity without selling at milkroad.com/Ledn, spelled Ledn. Meanwhile is the world's first licensed and regulated life insurance company built for the Bitcoin economy. They do everything in BTC. You pay in BTC, they pay claims to your family in BTC. You take out policy loans entirely in BTC when you need liquidity. Protect your family from life's uncertainty and a broken financial system. Build intergenerational Bitcoin wealth while the cost of living skyrockets in dollar terms. Plus, get all the tax and legal benefits of life insurance now in Bitcoin. Visit milkroad.com/meanwhile to join the waitlist and get early access to the world's first Bitcoin life insurance. Okay, we're back. Sam, what is the singleness of money? What does that mean, and how does stablecoins achieve that?
Okay, so first, yes, this is kind of a nuanced topic. I worked at the Fed. The Fed, being a Federal Reserve Bank, they love this topic. The idea is that we all take for granted now that when I have $1 of cash in my hand or $1 in a Venmo or PayPal balance, $1 in the bank, uh, these are worth the same amount, and we consider it to be the same dollar. That's actually a little bit weird because you might want to price like how hard is it to get the dollar out of Venmo? What if I need to send someone $1 in cash across the world? That costs something. They kind of have different value if you like really think it. They also have different credit risk. How likely is it that Venmo is going to default? I don't think they will. They're well backed. A bank, you've got consumer protections. These all became worth $1 after basically 100 years of regulatory work and building systems that made us think of them as being worth the same amount. And stablecoins aren't yet there. If I want to turn $1 million of USDC into $1 million of USDT using an AMM, I'm going to get slippage. I'm probably, maybe I get 995,000 out, maybe 999,000 out. That would never happen with a bank transfer. Jay, if I send you $1 million, you'd get $1 million, maybe less, like a $20, $40 fee, but you would get it on the other side. So given that, how do you think Microsoft is going to react when they get $1 million payment from a customer and they end up with 999 on the other side? It doesn't work for their business model. And so, as you read in my piece, I wanted to share some ways that we could integrate stablecoins into overall money and make sure that when you receive a stablecoin, you receive the full dollar and you can treat it like you treat the rest of the money in your life. It's really an important issue for institutional adoption and adoption of stablecoins in payments that are happening at scale in the sort of $1 million plus range. So we can go through some of the solutions. One really interesting one is a clearinghouse. Can we imagine a world where all stablecoin issuers have to register their stablecoins in a central place and guarantee that if you go to that central place, you can withdraw fiat or a different type of stablecoin out at par, at 1-to-1 ratio. Another is just better AMMs. We could imagine AMMs that concentrate liquidity even more tightly to make sure you have the least slippage possible. I think that buries a little bit of the lead. Like you still have some slippage, which makes at some scale the enterprises will struggle with this. Um, and there's third options, like what if we tokenized treasuries and said instead of having one-to-one fungibility of the stablecoin, you can always unwrap the stablecoin, turn it into a treasury, and that's going to trade one-to-one, and you could do sort of movement that way. So I walked through a bunch of solutions. Mostly, I'm just pointing out an open problem. Like we're all so excited about stablecoin adoption. I love seeing all these fintechs onboarding, and they should be onboarding because stablecoins are a better way to build a fintech now. But there are questions that are outstanding for the largest institutions and for what's going to happen when we end up with 3, 5, 15, 25, 100 different stablecoins. How do we make this into a usable world where you're not worried about having money that's worth less than $1?
Yeah, the things that stand out to me here are okay, there's great opportunities for builders because I think from the outside it's natural to assume, oh, there's already stable coins that have won. They've got a big moat. You look at Tether and Circle and you're thinking, okay, it's a done deal. But we're so early. And what you're saying is we actually need more infrastructure around stable coins in order to offer the same solutions that we have in traditional finance. So there's big opportunity there. And then also the regulation side stands out to me. And then I guess the decentralized nature of crypto kind of is opposed to some of this regulation. Where does this all like come out? Are we waiting for the regulation to be finalized? And is that sort of the next major catalyst, the next major step here?
Yeah, look, there's a lot there. I get why maybe you wouldn't want regulation in crypto. I think I really believe in permissionless composability, but ultimately we want to have a unit of account. We want assets worth exactly $1 that are fiat reserve. We want these stable coins, and one of the best ways to do that is to have clear rules of the road for how stable coins are constructed. So I'm really excited about the idea of the Genius Bill going forward to just allow entrepreneurs to build with sort of a clearer mind. I think you asked a few other questions in there, which we could get into, but I
Go
think
ahead.
just the last point on this is like the when we talk to businesses that are considering stablecoins, they bring up two topics. One is what's the path to regulatory clarity? I'm not willing to take a risk with my business on a new payment rail. And so now we have an answer that's coming forward for that. And the second is where is the table stakes payments infrastructure? How am I going to accept a credit card? How am I going to do a chargeback if someone is fraudulently charged for something? What about refunds? What about taxes? We need to handle those scenarios as well. And luckily, stablecoins are more programmable. They're permissionlessly programmable. If you're an entrepreneur listening to this, please go build solutions to those problems. Like we're so close, and people are finally have woken up to the value of a cheaper payment rail. But they do still need those things answered, and so that's one of the great big opportunities ahead of us over the next 6 to 12 months.
You pointed out two other issues in your article, and we don't have time to go through both of them because I want to get to your investment framework.
Yeah.
But I just want to give you a chance to touch on either of those points, whether it be the way that stablecoins are used so much in developing countries, or
Yeah.
whether you want to talk about the last point around treasuries coming on chain, which you talked a little bit about before.
I think the treasuries one is really interesting. And so, look, we've got $260 billion of stablecoins outstanding, about 1.1% of the total US money supply. But stablecoins are better money. It's a more programmable, more accessible, it's a better way to build a fintech. I think stablecoin volumes are really going to grow over the next year, 2 years. What happens? Well, by far the dominant version of a stablecoin is a fiat reserve stablecoin, a stablecoin that's backed by US treasuries, mostly the 90-day US treasury. And actually, that's in limited supply. There's about $7 trillion of of treasuries that could be used as collateral for stablecoins. And what happens when stablecoins 10x, which I think is somewhat likely. Uh, well, if that happens, then stablecoins and stablecoin issuers are going to be responsible for 10 to 25% of outstanding T-bill issuance. I think this is a great thing to discuss with your friends and peers, and I'd love to hear your thoughts on the matter. But there's a couple of ways to deal with what's ultimately going to be a lot of demand for these T-bills. One is the U.S. can shift more of the total debt to being into short-dated T-bill debt. Um, Another is that yields go down on treasuries because there's more demand and therefore yields go down. A third is that we can have new types of stablecoins. We don't have to be stuck with just fiat reserve stablecoins. Fiat reserve stablecoins are the easiest to understand and regulate. They're often compared to narrow banks, banks that are where all assets are backed by treasuries. But I'm looking forward to seeing people experiment with deposit-backed stablecoins, CDPs like Maker, and I want to see more ideas there.
Mhm, mhm. Uh, that's a nice transition into the next question, which is your investment framework, because this is this is the hardest part I find about stablecoins for our audience, right? Is our audience is well aware of the potential and all the numbers that we've talked about today, uh, but it's difficult to get exposure and upside to stablecoins. I think a lot of us are sitting here being like, "Yeah, I'm in. I'm fully believe in stablecoins," and but you can't. I mean, now you could go invest in Circle.
Yeah.
You can't invest in Tether. You you can't. A lot of what is being done with stablecoins. I mean, sure, you could go invest in Stripe or one of the traditional fintechs, but
Well, Stripe's also
there's not
private.
right. Oh yeah, right. You can't even invest in
Yeah.
Stripe. That's right. So there's not a lot of opportunity. Talk to us about how do you think about how do you break down your investment framework for stablecoins?
Yeah. I spent I spent a ton of my time thinking about this. It's not as straightforward as I might like. The Instead of talking about where specifically to invest, I just want to give sort of my framework for thinking about it. When you think about stablecoins, you probably think first about the issuers. So Circle and Tether are two really prominent ones. Maker is another with a different strategy. And then you might think about the orchestration layer. So you might remember that in the fall, Stripe acquired Bridge for about $1 billion. This is one example of an orchestration layer, something that helps an enterprise or a user use stablecoins and integrate them into their workflow without dealing with the wallets and like what kind of stablecoin did I get, and they simplify this. They're a service integrator. That's right. Actually, oh, and then on top of that, there's remittances and other apps that sort of use stablecoins. So that is pretty narrowly what most people consider to be the investable world in stablecoins. But I'm always encouraging people to expand their horizons a little bit. What enabled all that to be possible? Well, it's faster L1s and L2s is one of the key things that made payments possible. It wasn't until about 18 months ago with Base and OP, although Solana had these kinds of speeds as well, that we had the ability to send any amount of money for less than 1 cent and in less than 1 second. That's a key. That's a key innovation. It's enabled by better blockchains. And then at the same time, there's wallets. You need better wallets in order to have people custody and use stablecoins. And then, of course, there's DeFi and identity. I think once you start paying people with stablecoins, you realize there's a lot more that you'd want to do. You might want to take out a loan against your assets. You might want to you might want to get yield on your assets. I think you might want to know someone's name, like I'm Sam Broner dot ETH. These kinds of coordination mechanisms are really important, and so that sits sort of to the side of the app layer, the orchestration layer, and the issuance layer. I think people really got to remember that the blockchains enable all of this, and there's a couple of services which are basically DeFi identity and coordination. Intents are another one that you can that you probably want to use if you're using stablecoin payments. And so these things that kind of come along with stablecoins, it's been a big focus for us.
Mhm, mhm. If is there a clear winner in when you bring up the L1s and the L2s? Is there a clear blockchain winner in your mind for stablecoins? Is it still too early?
I think a lot can change because even though stablecoin payment volumes are large, in between Visa and ACH, we have not seen traditional finance move into stablecoin payments in mass yet. There's a lot of room to grow. I think that you should all check out Darren's piece that you put up before, Jay. Like Ethereum and Tron continue to dominate, but there's a lot of growth on Solana, Arbitrum, and Base. And so, the clear winner, no, but those five names definitely come to mind early. And of those, the L2s on ETH and Solana are the ones that offer the sub-second, sub-cent payments. And so my guess is that we'll see payment flows continue to accumulate in places with those kinds of technical offerings.
Before we wrap, Sam, last question is w- where does this all go in the short to medium term? So we're at 260 billion stablecoin volume today. Uh, let me ask you to break it down like this. When will we get regulation, like not regulation, legislation? When will we get legislation finalized? Is that like days, weeks, months? And then what do you see happening in terms of adoption in the next 6 months, 12 months, some sort of medium time frame?
As much as I wish I was a fortune teller, unfortunately, I don't know when the legislation is going to happen. Uh, but it seems really promising, and I think people realize that this is common sense legislation with clear rules of the road for how to make a safer product that benefits the consumer and the merchant and so forth. So I feel really optimistic. Uh, in terms of growth, I mean, check out some of my recent writing. I did a newsy post on all the fintechs that adopted stablecoins in the last 2 months. You can find just Google me basically. Um, but we're seeing really significant institutional investment in integrating stablecoins into core enterprise flows, into payments, into B2B payments, into B2C payments, into offering checkout with stablecoins. Uh, I'm seeing it first because I'm helping some of these companies figure out what the best tools are. uh, Hopefully, I know how fast these kind of businesses move. You're going to be seeing it in 3, 6, 12 months as they actually roll out these features. And so I think adoption's really going to grow, and you're going to have a lot more places that you can spend your stable coins on a day-to-day basis. And a lot of businesses are going to shift processes to being on stable coins because they're just better than bank transfers, international, a better way to do international payments, especially.
Yeah, it feels like there's a lot happening with stablecoins that we don't necessarily know about yet. I'm not sure if that's the right way to say this, but what I mean when I say that is, uh, like I heard from somebody who works at Google that they use stable coins to pay a lot of their staff in foreign countries because it's easier to send them money if they're in Argentina or in these in the developing world, and it's also better for the team member, the staff member there, because they would rather have a US dollar denominated pay than have their own currency. So it just, I think that it's one of those things where it's not getting a lot of attention, but it is growing so rapidly and being used in, again, non-speculative ways, real ways. And it just feels like, I guess, is there a catalyst or a tipping point that's coming that you think could expedite and turn the growth into even become faster? Or is
Yeah.
it we're on a consistent trend line and we're growing at a great rate, don't get me wrong, and we're
Yeah.
just going to continue to grow?
Well, I'll tell you a quick anecdote. The like Stripe, big company, they are live in before stablecoins, they were live in 42 countries. After stablecoins, right after they launched this financial accounts product that's built on top of stablecoins, they're live in 160 countries.
Wow.
And that's because of how easy it is to build fintech infrastructure on top of stablecoins. It's really a leg up. So as more fintechs enable these features, we're going to see this is a network effect. Every fintech to offer a stablecoin feature, every user to hold it, every merchant to accept it, it makes stablecoins more valuable to have to save and spend because they're accepted in more places and more people are familiar with it. It's one of the ultimate network effect businesses. And so, speed up, stay the same. I'm not sure, but the network effect is getting stronger every day. And I expect to see more and more businesses and people trust stablecoins as a way, yeah, to hold their money.
Sam, thanks so much for joining us today. Absolute pleasure to get you on the show.
Really nice to meet you, Jay. See you at Permissionless.
Oh yeah, can't wait. Actually, I won't be there, sadly.
Oh, Jay.
But my team will be there. But my team will be there. I wish I could be there. I've been at it before. It's a great conference.
Come through.
But I got too much going on at home right now. Before we wrap up, as always, I need to remind you all that none of today's episode was financial advice. I'm not your financial advisor. Sam is not your financial advisor. You should do your own research, and you should always think before you invest, because investing is risky and it is difficult. And if you need any help with your investments, you want to check out the recent Milk Road Pro article from this past Saturday. It is our June market pulse, where we give you our outlook for what we think is going to happen in the crypto markets in June. With that, thanks for tuning in, everybody. Have yourselves a wicked awesome day. We'll see you back again tomorrow. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter, where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio, where you can see exactly what we are buying. This is your #1 resource to help you invest successfully in crypto. One final note: this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.